So here's just in graph form, pull straight off the Freddie Mac website. This shows either the 30-year fixed rate mortgage or the 15-year fixed rate mortgage. We'll focus on the 30-year because that's most often what's quoted. Over the last year and a half, you can see that interest rates have gone way up.
Yep.
We got close to that dreaded 8% figure out there. Since then, you've probably read a lot of articles. You've probably heard a lot of talking heads talking about how the question is not how much more is the Fed going to raise rates. The question is now, is the Fed done raising rates? And when is the Fed going to start lowering rates? And when the economy, the investment population believes that the Fed rate hikes are at an end, what they start to do is to create more demand for investments like mortgage-backed securities. And a mortgage-backed security is just a fancy term for the mortgages that we pay interest on. The investor on the other side receives that interest rate. So there are investors on the other side who make a decision. Is it something they want to lend their money out or invest in that investment? So when the Fed says, hey, listen, we're probably done raising interest rates, which is a lot of what they're signaling now, the opportunity for an investor to lock in a high, what they perceive to be the highest mortgage-backed security return on investment is there. And so you see a lot more demand for the back-end investors of these mortgage-backed securities to come in, buy that asset, invest in that asset. And ultimately what that does is it drops your interest rates because there's more demand on the back end, which we don't normally think about. And so ultimately that's the biggest movement here. And that's what you're seeing. That is, in essence, why long-term interest rates have been dropping, even though the Fed hasn't changed anything yet. There's more demand for that investment.
Got it.